in part A of the required. First, you need to calculate the direct labour variances for division A in as much detail as possible. Then after you've calculated the labour variances in as much detail as possible, you need to reconcile the flexed direct labour cost to the actual direct labour cost. And after that, you need to prepare the journal entries for direct labour. All right, so let's go back to the information provided in the scenario. We were given information about idle time and productivity levels. So that means it's possible to calculate a rate variance, an idle time variance, and also an efficiency variance for labour. Please note further, guys, you can see from the required that we are dealing with direct labour. And remember, if it's direct labour, it's safe to assume that the cost is a variable cost. You'll remember from our lecture in standard costing, your labour variances, or the way that you calculate your labour variances, depends on whether labour is a variable cost or a fixed cost. So it's very important that you identify that up front before you perform the calculations. If labour is a fixed cost, you're going to perform the variance calculations in the same way as you would for fixed overheads. However, if labour is a variable cost, we are then going to look at calculating a rate variance, an idle time variance, and an efficiency variance. All right, so in this example, we are dealing with labour as a variable cost. All right, so first we are going to calculate the variances in as much detail as possible. Now remember, when it comes to your variance calculations, we always start with the actual cost. So the actual rate multiplied by the actual hours. Then the only thing that we change is the rate, and we keep the hours exactly the same. And that is going to give us a rate variance. Then, because we have idle time in this question, you were given information relating to productivity levels, idle time, etc. So you know it is possible to calculate an idle time variance. We then repeat this, standard rate multiplied by actual hours. Just repeat that. Now, this is going to give us our idle time variance. And the only difference between these two amounts is this is based on clock information and this is based on work information. Please note that this is also based on clock information. Then, in order to calculate the efficiency variance, we keep the rate the same and we just change the hours. And that will give us an efficiency variance. Right, and this is also based on work information. So it goes clock, clock, work, work. And then please remember the standard hours must be flexed to actual production. All right, so let's start with the variance calculations and then we'll see what other calculations are necessary. So first we need the actual rate per clock hour multiplied by the actual clock hours, or in other words, the actual labour cost. So if you go back to the information provided in the question, we were given the actual labour cost for the 2019 financial year. The actual labour cost is 2.4 million rand. All right, then we need the standard rate per clock hour. Now, you have not been given the standard rate per clock hour. You've only been given the standard rate per work hour. The standard rate per work hour is 50 Rand, and labourers are expected to be idle 10% of the time. Now, using that information, it is possible to calculate the standard rate per clock hour. So that's going to be the first calculation that we are going to look at. All right, we need the standard rate per clock hour. We don't have the standard rate per clock hour. You've only been given the standard rate per work hour, which is 50 Rand. However, we do know that labourers are expected to be idle 10% of the time. Or in other words, they're expected to be 90% productive. So if you've been given the standard rate per work hour and you need to convert that into a standard rate per clock hour, you need to multiply by the expected productivity level. So in other words, you need to multiply by 90%. So the standard rate per clock hour is going to be 45 Rand. All right, now before we go on, I just want to make sure that you guys understand the logic behind these calculations. So please note the calculations that I'm going to look at next are not necessary for you to perform the variance calculations. You've calculated the standard rate per clock hour. You can now take that standard rate per clock hour and include it in your calculation over here and use that to calculate the rate variance. Right now what I'm looking at is just making sure that you understand the logic behind these calculations, where you have clock hours and work hours, because it can get quite confusing. So first, what's important to note is, according to the standard, it should take 4.5 work hours to produce a single unit, and the standard rate per work hour is 50 Rand. So if you've been given the standard hours per unit and also the standard rate per work hour, we can use that to calculate the standard cost per unit. So the standard labor cost per unit. According to the standard, it should take 4.5 work hours to make a single unit, and the standard rate per work hour is 50 Rand. So that gives us a cost of 225 Rand per unit for labor. So that's obviously the standard cost per unit for labor. Now guys, remember from our lecture, the logic is this standard cost per unit doesn't change. So you can either perform the calculation using work hours and the standard rate per work hour, or you can perform the calculation using clock hours and the standard rate per clock hour. But the cost per unit must stay constant at 225 Rand. So that means if we want to calculate the standard clock hours per unit, we know that the standard cost per unit for labor is 225 Rand, and we know that the standard rate per clock hour is 45 Rand. So that's going to give us an answer of 5 clock hours per unit. And you can test the logic, guys. Look at the logic of this. According to the standard, it should take 5 clock hours to produce a single unit. The standard rate per clock hour is 45 Rand, and that gives me a unit cost of 225 Rand. So that's obviously using clock information. Using work information, we get exactly the same standard cost per unit. So you can see, using work information, it should take 4.5 work hours to make a single unit, and the standard rate is 50 Rand per work hour. That gives you a unit cost of 225 Rand. So that's using work information. Using clock information, according to the standard, it should take 5 clock hours to produce a single unit. The standard rate per clock hour is 45 Rand, and that gives us a unit cost of 225 Rand. So the unit cost remains constant. And you can also test the logic by saying, according to the standard, it should take 5 clock hours to produce a single unit. And if the workers are idle 10% of the time, that means they're only working 90% of the time, which means they are only working 4.5 hours. So that shows you the logic. Please note these calculations are not necessary. You did not need to perform these calculations in order to calculate the labor variances. I've just included these calculations over here to make sure that you guys are happy with the logic. Make sure that you are happy with that logic, please. So let's then wrap up the calculation of the labor rate variance. The standard rate per clock hour is 45 Rand, and we need the actual clock hours. So go back to the information provided. We know that they actually clocked 48,000 hours. All right, so using that information, we can calculate the rate variance. All right, and you can see the actual cost is higher, So that means the actual rate is higher than the standard rate. So this variance is then going to be unfavorable. Then next we are going to calculate the idle time variance. And remember guys, save time. This variance starts where the last variance ended. It's the standard rate per clock hour multiplied by the actual clock hours. So bring that information down from above. All right, and when we are calculating the idle time variance, it's just the difference between the clock information and the work information. So now we need the standard rate per work hour. And the standard rate per work hour was given in the scenario. It's 50 Rand per work hour. Then next we need to calculate the actual work hours because the actual work hours were not given. Guys, please just make sure that you do reference all of your calculations. So above I calculated the standard rate per clock hour to be 45 Rand. That was calculation 1. Please reference that. The actual work hours is now going to be calculation 2. And it's a simple calculation because we know that they actually clocked 48,000 hours and they were actually 92% productive. So you can easily calculate the hours that were worked. All right, so they actually worked 44,160 hours. All right. Then remember, to determine whether this variance is favorable or unfavorable, you need to compare the productivity levels. According to the standard, they thought that workers would be idle 10% of the time. So they thought they would be productive 90% of the time. They were actually 92% productive, so they were more productive. If they were 92% productive, it means they were only idle 8% of the time. So the idle time, your actual idle time, is less than the budgeted idle time. So this variance is going to be favorable. Now, once again, I'm going to include an alternative calculation, but obviously, guys, you won't perform the alternative calculation. You either perform one calculation or the other calculation. You don't have time for both. But you'll remember from our lecture, I said to you that performing the calculation in this way as we have above will always give you the correct answer. However, it doesn't really follow a logical approach. But it works very nicely with my framework that I've provided you guys with in order to calculate the rate, idle time, and efficiency variances. So because it will always give you the correct answer, I recommend that you perform the calculation in that way because it works with the framework. However, the logic behind the idle time variance calculation is you should be comparing the actual idle time to what the idle time should be. So in other words, if they actually clocked 48,000 hours. The idle time should have been 10% of that according to the standard. So they should have been idle for 4,800 hours. So you compare what the idle time should be to the actual idle time. And the actual idle time, if they were 92% productive, then they were only idle 8% of the time. So your actual idle time will be 3,840 hours. Okay, so they should have been idle for 4,800 hours. They were actually only idle for 3,840 hours. So calculate the difference between those two. So that gives us 960 hours. We then multiply that by the standard rate per work hour, which is 50 Rand. And once again, you'll see we come back to exactly the same variance of 48,000 Rand. And the variance is favorable because the actual idle time was less than what it should be according to the standard. All right, then lastly, we just need to calculate the labor efficiency variance. All right, and once again, to save time, remember this variance starts where the last variance ended, so you can just bring this down. All right, so the standard rate per work hour is 50 Rand. We then need to calculate the standard hours, and those standard hours must be flexed to actual production. So if you go back to the information provided in the scenario, according to the standard, it should take them 4.5 work hours to produce a single unit, and we need to flex that to actual production. So how many units did they actually produce? They actually produced 10,000 motherboards. So according to the standard, it should take 4.5 work hours to produce a single unit. They actually produced 10,000 units, so it should take 45,000 hours. All right, so if they actually produce 10,000 units, it should take 4.5 hours per unit, so it should take 45,000 hours. It actually took 44,160 hours, so because it actually took less time than what it should have, this variance is going to be favorable. Then next we need to reconcile the flexed direct labor cost to the actual direct labor cost. All right, so we are now looking at a reconciliation. And we are reconciling the flexed direct labor cost to the actual direct labor cost. Now guys, obviously the only reason for the difference between the flexed cost and the actual cost is all of the variances that we calculated. So it's going to be the rate variance, the idle time variance, and the efficiency variance. So if we start with the flexed cost and we take all of those variances into account, we should come back to the actual direct labor cost. All right. So first, how do we calculate the flexed labor cost? Well, we need the cost per unit according to the standard, and we did already calculate the cost per unit according to the standard. It's 225 Rand. That is your standard cost per unit for labor. And this is flexed to actual production. So you need to multiply it by actual production of 10,000 units. Remember guys, the logic behind this is when we are calculating our variances for standard costing purposes, we never compare the original budget to the actual results. We always compare the flexed budget to the actual results. So if you took the cost per unit of 225 Rand and you multiplied by 9,500 units, remember they budgeted to produce 9,500 units. That's incorrect. That's the original budgeted labor cost. 225 Rand per unit times 9,500 units. That's your original budget. That needs to be flexed to actual production. So it's 225 Rand per unit multiplied by 10,000 units that were actually produced. Then we can take all of the variances into account. So the rate variance was 240,000 Rand unfavorable. Now remember, guys, you are reconciling a cost over here. So if a variance is unfavorable, it's going to increase your costs. So because this variance is unfavorable, it should increase the cost. The idle time variance and the efficiency variances were both favorable. The idle time was 48,000 Rand favorable, and the efficiency variance is 42,000 favorable. And if these variances are favorable, it should reduce your cost. Remember, if the variance is favorable, it means that your actual cost must have been less. So favorable variances will decrease your actual labor cost, and unfavorable variances will increase the actual labor cost. And then you can work out the actual labor cost, which is 2.4 million. And that ties into the actual labor cost that you were given in the question, the 2.4 million Rand. So you've reconciled the flexed direct labor cost to the actual direct labor cost. Then finally, we need to prepare the journal entries for direct labor. So first, we need to record the actual wages that are payable. And we debit the wages control account. And we credit wages payable with the actual labor cost of 2.4 million Rand. All right. So please note, this labor cost over here is not expensed, it's taken to a control account. So you don't debit a labor expense, because remember, this is a product cost. It's not a period cost. It's a product cost. We include direct labor in the cost of inventory. So don't expense the cost, you take it to a control account, and then in the next journal entry, we're going to take it out of the control account, because remember, a control account must always balance back to zero. So we'll credit the control account with 2.4 million so that it balances back to zero. And instead, we are going to include this cost in the cost of our inventory. So we are going to transfer the cost to work in process. And by doing that, guys, we are including the labor cost in the cost of inventory. Because remember, inventory is made up of three categories: raw material, work in process, and finished goods. So if I take this cost to work in process, I'm including it in the value of inventory instead of expensing the cost, which is correct. So we are going to take it out of the wages control account. You're going to credit the wages control account. So that it balances to zero. And we are going to debit work in process. But we never take the actual cost to work in process. To work in process, we take the standard rate multiplied by standard hours. Now you have already performed all of these variance calculations. There's the standard rate multiplied by standard hours. It's 50 multiplied by 45,000. Or in other words, it is your flexed direct labor cost. That is what goes to work in process, not the actual labor cost. All right, and then the difference between these two amounts, because obviously you can see this journal entry doesn't balance, that's all of your variances. So unfavorable variances will be debited to profit and loss, and favorable variances will be credited to profit and loss. So the rate variance was unfavorable. So that's a debit to profit and loss. And the idle time variance and the efficiency variance were both favorable, so those will be credits to profit and loss. Right, and that journal entry then balances. Okay, so what have we done? First, we recorded the actual wages payable. We didn't expense this, we took it to a control account. We then cleared out the control account and instead included this in the value of inventory. We took the cost to work in process. Now what we need to do is actually pay the wages, because over here we didn't credit bank, we credited the wages that are payable. Now we need to debit that and actually pay the wages. All right, and that's obviously the actual labor cost. All right, and that then deals with part A of the required.